Hey everybody, Jamie O'Brien with O'Brien Homes. Starting up this interview series again. I'm going to do a few of these here and there. We first started out this whole interview process trying to get through the COVID-19 crisis. I wanted to bring you some insight into what was happening in the investment side of the world, also the retail side of real estate. That kind of fell off, to be totally honest with you, so I apologize for that. But we're gonna get this back up and going. It won't be as aggressive of trying to put out content every day. But today I wanted to bring in a good friend of mine, Jeff Henderson. He's with Method Mortgage. He's a mortgage broker, and he's helped me with a lot of properties. I wanted to get Jeff on here earlier in this COVID-19 situation to kind of see what was happening with lending and loans and where we thought we were going. It seems like we're kind of on the back end of this, hopefully. But Jeff, I appreciate you coming in and talking with us today. I still am very interested. I know we talked personally a couple of weeks ago, and there's still some things going on, especially seems like on the extremes in the investment side of the lending business that are going to have some effects for a while to come. So Jeff, tell everyone who you are, kind of what you do, and we'll just open it up from there.
Thanks, Jamie. Like I said, Jeff Henderson, Method Mortgage in Vestavia here in Birmingham. A broker. We work with 10 different lenders. Been doing it for about 5 years now. Before that was a banker, so definitely familiar with the mortgage market. But yeah, we purchases of and refinances of primary residences, second homes, vacation homes, and obviously while we're here is investment properties.
Yeah,
it's like an increasingly attractive thing for investors in the market right now with rates where they are. Yeah. But some things that we need to make sure investors are aware of on the front end, because like you were saying, COVID has changed the playing field and the rules a little bit.
Sure. Well, I'm doing everything I can to impress you. I want you to know that this is the first time I've done one of these without a hat on and with a collared shirt. So I'm trying to find the guy with money here to help us out. But I want to start really basic with you, and just for people that maybe don't know, what is a mortgage broker and how are you different than like a Regions Bank or one of the big banks when people are coming to look for a mortgage?
Yeah, and I get that question a lot. The difference in a broker and and a banker is, I just give an example. I work with, like I said, 10 different lenders. Some of them are banks, some of them are mortgage lenders, and some of them are banks you can just walk right into and speak with one of their in-house lenders.
Sure.
And how we're different is, and the way that we, compete with them and like a better term, beat them is. When you apply with us, you're, the lenders that I'm working with are competing with each other for me to get your loan.
Right.
If you go into the bank, it's like, hey, here's what we got, in-house lender, go sell it. Here's what our rate is, go sell it. I can check 10 different lenders based off your scenario and say, okay, well, this lender's the best today. This one's got a little bit better underwriting experience.
Sure.
It's going to be a little less painful. And try to tailor it to what you need. The other way is, with the banks, they're paying their in-house lenders, insurance, they're paying all their overhead, laptop, et cetera.
Right.
We handle that on our end at Method, and so we get what's called wholesale pricing from the banks and the lenders. And, we pass that on to the clients to win more deals.
Gotcha. So options, it sounds like you guys.
Exactly. It's options and stripped down pricing.
Yeah. Well, without sounding too promotional for you, you've always done a great job for me.
Sure.
We've worked with you personally on, I think 2 of our personal residents now and several of our investment properties. So I appreciate you, and you've always done a great job for us. But getting into this a little bit, one of the reasons I did want to get you on here is, I called you the other day. We've got a property that, and so how we tend to buy properties, especially rentals, I like to, we'll work with private investors for a short-term loan, usually about 6 months. We'll pay them a great interest rate for that period of time for short-term money. So we can buy the house cash, we can get in there, we can rehab the property. And then what I like to do, and you've helped me with a couple of these, is at about the 6-month mark, we'll do what's called a cash out refi, where I'll come to you and I'll say, hey, I need to get a mortgage on this property. I want to pull all my money out, cash out my investors, and maybe even put a little money in my pocket and try and at least get into that property with as little money in it as possible. And that's just a strategy that I really like. I'm not saying it's the perfect strategy, but obviously there's some pitfalls with that. And one of those is I called you, probably 2 weeks ago now, and asked you about this. And you said, hey, they're not really doing that right now. So talk a little bit about, just kind of where I want to go back, maybe just step back, and just go maybe a month and a half. Where were we? What did you see happen throughout the COVID process? Where are we now? And where do you think we're going in the next few months from a lending standpoint? Kind of you could be very general, but what are you seeing in the market? And obviously we can probably go down a million rabbit holes here with this, but
of course.
Yeah.
Yeah. Obviously COVID made, first of all, on the good side, it made rates go down.
Right.
So, where there is opportunity to save money, people have been taking advantage of that. But on the flip side of that was, obviously with unemployment on the increase, furloughs, voluntary and involuntary pay decreases, you're obviously going to see, mortgage payments slow down in a lot of cases. So lenders, and then beyond the lenders, the people that buy mortgage-backed securities,
right,
drive the rates,
sure,
got spooked, and and for good reason. And so they said, look, if we're going to start seeing the big buzzword was forbearance, or is which is people delaying their payments. They said we're not going to be making our money for a while. We're not going to pay as much, and we're not even going to buy certain securities, that are in the pool. That has kind of trickled its way up to us, saying, hey, certain scenarios are not going to be priced nearly as attractive as they were pre-COVID right now. And some scenarios are just, they're just not taking them right now. Lenders have suspended cash out refinances on properties. They've suspended cash outs on a lot of self-employeds. It's just become it's a day-to-day thing. There's a new email every day with, hey, we're doing this, we're not doing that now. But for our purposes, the investment properties are what we're focusing on, and it's gotten a little rocky, but there's still opportunities out there. I closed a investment property purchase last week.
Right.
Investment lending is definitely not dead.
Sure.
It's a day-to-day, hey, check with your lender before you go to anything. Say, hey, what's it looking like? What's the pricing look like these days? If I do this, am I going to be able to do that?
Yep.
Because nothing, it's outside of primary, residence purchases, it's not business as usual. And even in that case, there's still times where I'm like, let me make a phone call real quick.
Yeah, I heard some stories of, and you'll probably be able to speak to this a little bit better, but some of the banks requiring, was it 700 or 750 credit scores for a primary residence? Did you hear Chase maybe, or?
They might be. The in-house, like if you go to an in-house lender, sometimes they can, one of their advantages, I always want to say, be fair and say there are some advantages to going to it.
Sure. Yeah.
They can do what they call a portfolio deal, which means they do the loan and they hold it in-house.
Right.
So at the same time, they can also set certain rules that, might not be as easy as just going to Fannie and Freddie.
Right.
FHA. I haven't seen that.
Okay.
I saw, there was one, I had a buddy call me with, he's an investment banker at a major investment firm. And he said, hey, Brand X, big national bank that we're affiliated with, is saying we can't do this loan for this client, or they can do 6%.
Oh, yeah.
And this was a primary residence purchase.
Wow.
With 20% down. And
wow.
I said, okay.
Where are rates right now? So just to put 6% in perspective for everyone, what are rates floating around right now?
Primary residence purchase. Right before we got on this call, I was doing one for a client, and it was at 3%, even with no points.
Yeah.
Wow. So it's crazy. It's if you throw out one day in early March, we're at the all-time lows right now. And I always tell them, look, you can't worry about that day. You can't have FOMO for one day. A full day. It was like 3 hours.
Yeah.
I said, well, do you think it's ever going to hit that? I said, if it does, we'll take a look.
Yeah.
But, and again, this goes back to the investors that buy mortgage-backed securities. I don't know if we're ever going to see that low again because, they're building in some safeguards and some, they're just backing off certain stuff, and it's just keeping the rates high, or higher than they probably would be with respect to, bonds
right.
in the market in general.
Well, I mean, there's got to be a level where it doesn't make sense anymore. That's it's too low. And I mean, it's just general economics, and I won't go down that rabbit hole of all of that. But people have to remember, like, not that long ago, I mean, really, I think in the early 2000s, we're at 7%, 6-7%, maybe more, and go all the way to the 80s, we're at 15-18%. I mean, 3% is stupid low. 4% is stupid low. 5% is still a really, really good rate. Like, it's people get stuck on half a point. I've got a friend who's talking about refinancing for, like, not even a full percentage point off, and he's like, well, save me $100 a month. I was like, I get it, but I mean, you're chasing decimals. But anyways, that's a whole different conversation. So
we could talk about that or I could probably ramble for longer than anyone's going to want to watch this.
Well, one other thing, so just kind of moving on to the next subject, and I appreciate that insight on an investment, and I'll probably come back to that here in a little while, because I think that's going to be a roller coaster for a little while, and it could be more expensive, but that's one of the risks we take as real estate investors is, part of what I look at when I buy property are what are my exit strategies. And if you lose one of those, or it's temporarily put on hold, let's say, it just makes it a little more complicated. But as you say, I mean, there's some other options as far as looking at portfolio lenders and stuff like that we'll save for another day. But that was really interesting to me, though, that you just said. I mean, and historically, when I called you on property, I mean, your lenders were jumping all over those investments. So that's curious. What can you talk about in the retail market? I know we talked a little bit before the show. What I'm seeing, and shout out to Rob Drum and some of the guys that really put these analytics together. I'm just talking about information that I learned from them, so I don't want to take credit for anything. But it looks like our extremes are kind of contracting in Birmingham as far as purchase price. And does any of that, you think, have to do with the ability to get financing on some of those properties?
Oh, definitely. I mean, rates equal buying power. Rates go down, buying power increases. Rates go up, buying power obviously decreases. As far as like the retail market right now, I mean, if a house is sitting for over 2 weeks, there's probably a reason on the list side as opposed to the buyer side, because if you price something right now, I mean, it's in decent shape or whatever. Basically, if it's priced right, it's going to go quick.
Right.
But you are still seeing, the higher priced houses sit a little bit, and again, it's all about perspective. A $500,000 house is probably going to take a little bit more time than a $250,000 house, just because there's less buyers.
Right.
That can afford that just in general, even in normal times. And that goes up the ladder. You start seeing, the $1 million plus houses. It's probably not going to go under contract in 24 hours,
right?
Unless there's the unicorn buyer out there.
Yeah.
So I mean, rates are, retail, investment, rates are there. If the opportunity is there, people can really take advantage and save a lot of money right now.
That's great. That's great. So where do you think this is all going? I mean, kind of to just bring it all together. I mean, do you think that this is going to be a new state for a little while of, I guess, more caution from the lenders out there, or kind of just give me your perspective? I don't want to put any thoughts in your head. You probably have your own opinion, but I know that's very speculative. And if we all had a crystal ball, we wouldn't be on this podcast, right? We'd be on a beach somewhere. But
earning 20%.
That's right. So just give me your thoughts.
I mean, like you said, I mean, I don't have the crystal ball. I never saw that one day of hitting that all-time low. And I mean, sitting right here at, in the low threes, I didn't think we would see this ever again. 2 years ago, I mean, my wife and I bought our house, and I don't mind telling you, I mean, we were excited to keep it under 5%,
Right.
because
Right.
post-election rates were shooting up, the economy's just booming. It's like, oh my God, we kept it under 5, thank God.
Yeah. Yeah.
And I don't mind telling you, we've refinanced twice.
Yeah.
A year and a half.
Right.
And it's like, I never would have saw this. So let me qualify that. I didn't think I'd be sitting in my basement wearing a hat and a t-shirt,
Right.
working from home because there's a pandemic going on. No one saw that coming. But if we assume, things kind of get under control with this, I believe, in my personal opinion, I think rates will probably tread water in the between 3 and 4, which they were doing pre-COVID.
Right.
I mean, the mid to high 3s, pre-COVID. So, obviously we've got an election coming in November. We don't know how it's going to affect everything. But, with the Fed, saying that they're committed to buying securities and bonds, they want to keep it steady. And I think that they really are committed to keeping, long-term and short-term rates as low as possible, because that just helps the economy get back to normal. Right. As fast as possible, which is, their job and our, everyone's goal.
No, absolutely. And I think that's, there's obviously a lot going on to stimulate the economy right now. And I think it makes sense. It can't last forever though. Right. And so, it's the nature of it. And again, that's a whole different economics conversation, but I wanted to talk back. Something you mentioned a little bit earlier was forbearances. And I don't know, we didn't talk about this offline and I didn't do my homework. Do you have any idea what, kind of what the forbearance rate is, or what the percentage of loans that went to forbearance is out there on the market right now?
I can't imagine. As soon as I say that, there's going to be an article saying that it's higher. There was initially, like when you first heard about it, you're like, oh my gosh, yeah, I'm going to do that. I mean, you can delay your mortgage payment for 3 months. Who wouldn't do that? Well, then it started coming out that, wait, that's not, you really are delaying. You're not putting it on the back end. You're not extending it 3 months. Yeah. After 3 months, you're going to owe 4 months. So if you skip May, June, July, and August, you owe for May through August.
Right.
I mean, even numbers, if you owe, $1,000 a month, in August, you owe $4,000. So I think that a lot of people heard that and they went, oh, well, I can't do that.
Yeah. Yeah. And I know it depends on the lender, right? I mean, I know I looked into it on some of my investment properties just in case, when all of the no eviction stuff came out. I was like, what if I have somebody that just stops paying? I still have to pay that mortgage, right? Even if rent doesn't come in. So, just with everything going on at that time, I was trying to figure out my options. Right. And it looked like most of the lenders, at least that I held mortgages with, wanted to have a conversation with you about your situation and try and work out a couple of different programs. Some were, that 3 months is due at the end of 3 months. Some were, we'll add a certain amount onto your monthly payment for a certain amount of time. But rarely, like you said, did I see any extension of that mortgage term. Right. And so I think there was some, misunderstanding of what a forbearance was very early on. But I just looked this up because I'm horrible at doing my homework, but it looks like this is from, this is all the way back on May 18th. But as of May 18th, we were at 8.16%, or 4.1 million homeowners were in forbearance.
Yeah.
Which is, Freddie and Fannie, it says, is right around that 6%, which still seems like a big number to me. And so that just interesting. Do what?
A little over 1 in 20.
Right. And so, without sounding like a total vulture, I mean, I think there's going to be some opportunities here in the end of this year to hopefully pick up some rentals and some deals. But most of all, I think what it's really going to come down to just from a business side and kind of how we run our business is the opportunity to help people that get themselves stuck in sticky situations, right? So if somebody takes on one of these forbearance programs, maybe didn't fully understand it, or, thought they'd come out the other side different. And maybe they're still struggling with some lower wages or even unemployment at that point in time. Hopefully we'll be there to help them. And hopefully I'll have some options for lending at that point in time. But anyways, man, I really appreciate you coming on here. I think we could go forever. I try and keep these at about 15 minutes just to keep them simple. But is there anything you think I missed that people should know? I'm going to give you an opportunity to tell people how to find you, but I mean, just kind of anything that's happening right now that people should know about.
I mean, really, as long as everyone knows that it's, if they are above 4% right now, it's time to take a look.
Mm-hmm.
And like you were saying, you got the friend that, is going to be saving, looking at saving $100 a month. That's typically where I say the cutoff is. All right, if you're going to save at least 100, let's take a look, because I always look at it as, all right, the loan cost divided by the monthly savings.
Right.
How many months is that to make up for the closing costs, the loan costs?
Yep.
Because if you're going to have the house that long, then it makes sense from a cash perspective.
Right.
If not, then you need to hold off. If you're only going to save 100, and you're selling in a year, probably not going to make sense.
Yeah.
But that being said, like anyone over 4% on really any scenario, it's worth taking a look. Cash outs are, like we were saying, are a little more tricky, a little less aggressively priced.
Yeah.
But if you really need the cash out, let's take a look.
Sure.
And like you said one thing I did want to interject is, like you said, you don't want to be a vulture or anything. If you can help someone that's, in trouble,
right.
And help relieve them of that obligation, that's not being a vulture. That's a win-win scenario. And in a bad situation, you're turning a bad situation, you're getting the best result possible.
Absolutely. I mean, we talk about this all the time. We think this is a people business, and to us, it's about helping people and revitalizing neighborhoods and putting a good quality product out and affordable housing for everyone in Birmingham. Mm-hmm. Obviously it's a business. We need to make money on it, but we've got a lady that we have her house under contract right now. And the relief that came across her face when I told her we could get her payoff, she just wants out of the property. Right. She was so happy that we were going to be able to help her out of that situation. And, that's why I love this business. Yes, there's money to be made. And yes, I like the process of turning a house from a house that needs some love into something bright and shiny, but really it's a people business, and it gives us the ability to help people out. So, Jeff, how can people find you? Obviously, call Jeff is a hashtag. They can track you down by, but I love those call Jeff posts. But how can people find you if they're interested in talking to you about refinancing, or if they've got a new home purchase, or even an investment property? How can they track you down?
Either methodmortgage.com. I've got a Facebook page, Jeff Henderson, Mortgage Officer. Phone number is 205-706-3013. And yeah, hashtag call Jeff. I always try to get that thing trending on, at least on Instagram and Facebook. It's something I try to get out there and make it interesting. And, like you said, try to take care of people and help people.
Yeah.
I love that too. The people aspect of it. It's awesome being able to do a job where you help people.
Yeah, well, I mean, your reviews speak for themselves. If you just look Jeff up, man, people rave about this guy. And again, without this being too promotional, you've always been awesome for us. So I appreciate it. Well, Jeff, man, I appreciate you coming on, and we'll talk again soon.
Thank you, Jamie. Appreciate it.
Have a good one.